enough credit here, but I'll let them say their side. Let's first go around. Amit, how you doing?
I am doing good. Am I live on my channel?
Yeah, it says you are.
Okay, it's not live on. Oh yeah, now it's live. Oh, it's live. Yeah, I'm doing good. I'm looking forward to this. It should be fun. It kind of happened based on something I posted on Twitter today, and so yeah, I think there's a lot of discussions we've been having for the past 2 months, and this will be a good one to kind of get it all out there in the world.
Chris, how you doing?
I'm doing great. It's been a ridiculous week at work for the last couple of weeks. It'll be fun to talk something other than work.
And finally, last but not least, the great and powerful Stephen Fiorillo. Thanks for joining us.
You can tell by my facial expressions that I am super pissed off right now because the Yankees are getting smoked and the Knicks are getting smoked. I don't even want to turn the TV on. Like, I specifically had it off because of this. I turned it off. Next thing I know, the Knicks are down 15 or 16 points. Freaking Yankees are getting blown out 15-2. Not good.
Well, then we got your full attention. I mean, that's exciting too. We get to talk SoFi today.
He's going to turn on World of Warcraft halfway through if it gets too boring.
Yeah.
You know, Chris, I do have a 49-inch monitor that I'm using. It may be up on one of the panels.
Just a subtle brag there. Why don't we start off with the definition of a tech company? Steve, do you want to start off representing the bearish side of what is a tech company?
So first, I would be happy to. Not bearish SoFi. So let's just not put me in a bear camp.
You're bearish on the term if they are a tech company or not.
Much better. Much better. Okay. So tech companies are traditionally companies that sell software for recurring revenue, create technology, hardware, and equipment, or they're classified as semiconductors and semiconductor equipment. Those are traditionally what information technology companies are, because their core business focus is their primary revenue and operations stem from IT-related activities. That is the pure essence of an IT company.
I think that's fair, but we'll get into it. Chris, representing the bulls, what is a tech company?
Right. So I think, I mean, Roy had a good post about this where he kind of talked about how a tech company is more of a sliding scale, right? Like there's not there are like pure tech plays, right, in the market that exists. Those are the things that Steve's talking about, right? That are like IT plays that are 100% software, et cetera. But kind of as things like the lines have blurred over time, where now something you can be like a financial company and a technology company, which is, you know, commonly referred to as a fintech, right? That's where I think SoFi fits, right? Is the fact that they have tech that enables them and allows them to do a process better, more efficiently at higher margins than kind of traditional companies. And so like, that's what I guess there's a scale there, right? Like you're going from somebody who's just a pure non-tech company to something that's more like that is technology based or sells technology itself. I don't know. We'll get into it more detailed, but that's kind of, yeah, that's Roy's point, right? It's not a binary, but the fact of the matter, to me at least, is that technology enables everything that SoFi does. And that for me qualifies it. And then that also leads to higher margins than traditional companies. It leads to, you know, greater agility. It leads to less friction for the customer. It leads to a better customer experience because it's more tailored to the customer. So all the fact of like technology is an enabler of other types of businesses as well. And so again, there's a sliding scale there, but that's kind of how that's how I typically think of tech companies, right? Like I consider Robinhood a tech company, even though, you know, they're also not an IT company like Steve was talking about.
Amit, do you also consider Robinhood a tech company?
Yeah, I largely agree with what Steve said. I think I agree with some parts of Chris's argument that if you use technology in your business, you can be classified to an extent as a tech company. But I think the crux of this debate is SoFi's stock price that has not gotten a multiple and presumably a tech multiple like a Robinhood or a Palantir. And that's where I have some disagreements around their use of tech being incongruent with their perception of the market as a tech company, which we'll get into.
Yeah. Tannor, before you answer, I just want to add one thing. There's a big difference between utilizing technology to offer your products and actually being a technology company. Every bank utilizes technology for their product offerings. JP Morgan has 50,000 people in their IT department with 43,000 software engineers. They've engineered pure play platforms for JP Morgan. Every bank and every finance company utilizes technology. That has never been my argument. My argument has always been that while SoFi utilizes technology to create their infrastructure, that does not make them a tech company. They are a finance company that uses technology.
I don't even necessarily disagree with you on your definition of what a tech company is. I think it's whatever drives a tech multiple, right? Which is honestly probably shouldn't even be called a tech multiple. It should be called a hyper growth multiple or something like that. But I would say that SoFi, falling under a definition more closely to Chris's, is a digitally native business that leans more onto the tech-sided tools than what a traditional JP Morgan might do, asking clients to come in on Wednesday so then they can sign papers in the branch. Obviously, they still do use a lot of tech, though. So why don't we get into what potentially SoFi is doing that the people under here, the lower bound, think that doesn't classify them enough to place them in an area that potentially Robinhood is being placed in as more of not a tech company the way that Steve would put it, but more of a tech-enabled financial services company. Because like Steve, I think if I could ask a question independently to both of you, Amit, do you think Robinhood's a tech company? And then Steve, do you think Robinhood is a tech company?
Yeah, I think both of us agree that the technical definition of Robinhood, as per like where the S&P 500 would put them, is a financial, not an actual technology company, like a Meta or something. However, when you look at their operating margins, when you look at their speed of innovation, when you look at their communication, it resembles everything that a tech company does, which is why, to me, it's not a question of is Robinhood a tech company? Like, yeah, I personally believe that. But the multiple they're getting is, as you said, hyper-growth technology enabled, which is what actually matters. So the semantic of is Robinhood a tech company or not, I think that's irrelevant. The question is it getting a tech multiple? And the answer is yes, for a lot of reasons. And I think that's we disagree on the reasons on if SoFi can match the reasons why Robinhood's getting that same hyper-growth multiple.
Well, let's jump right into those reasons then, because I think that'll be the fun part anyway. What separates Robinhood that gets them that multiple that SoFi potentially is not doing?
Steve,
can I take this?
Yeah.
Glad you asked, Tannor. Glad you asked. Please share. And keep in mind, I own a lot of SoFi. I do not own a single share of Robinhood. So it does not benefit me in any way to go against SoFi. Like, let's be very clear that I have a very large position in SoFi.
Gotcha.
$0 allocated to Robinhood, other than whatever ETFs it may be in that I own indirectly.
And also, by the way, I've heard this argument, which is a silly argument on Twitter as well. Oh, Steve is doing this because he likes Amit and he's one of Amit's good friends. I told Steve to buy Robinhood at $7 and I still give him shit.
I didn't buy it.
And I still give him shit 3 years later. So it's not because he wants to be friendly with me.
And in all
Make sure
fairness,
you zoom in, Steve.
Sure. And in all fairness, when Tannor made the joke about bringing Vlad to lunch, I said, no, because I want to hang out with you guys, not Vlad. Like, I have no allegiance to Robinhood. So let's be very clear about that. So I consider both of them financial companies because the lion's share of their business is derived from financial instruments, regardless if it's options, investing, crypto, lending, credit cards, whatever it is traditional finance. Okay. Hood is getting a much bigger multiple than SoFi because of its operating margins and its revenue growth. On a year-over-year basis in Q1, Hood grew its revenue by 50%, SoFi 20.12%. On a operating income basis, year-over-year in Q1, SoFi lost just over 15% in margin, and Hood increased by over 114%. There's a clear reason why the market is giving Hood a different multiple. And when you look on a TTM basis, which is this column, Hood generated $1.23 billion of operating income in the TTM. SoFi generated $220 million. The operating margin for Hood is over 37%, and SoFi is less than 7%. These are not made up numbers. These are the numbers. You can fact check this. Anybody can fact check this.
We believe you. We
These
believe you.
are the numbers. Now, I get it. I bought SoFi and I bought into the whole premise of SoFi for everything that Chris said. And I do want all that to work out. But I am not seeing a company that has any moat around their margins. And the idea that they're investing heavily, well, that's great, but there's no guarantee that those investments are going to play out in the future. What the market is looking at is the numbers that they're putting up. And two of the largest fintech companies are SoFi and Hood, or the most popular ones are SoFi and Hood. And when you break down the numbers, Hood's margins blow them away. I mean, this is why Hood gets a different multiple than SoFi and why the market is not giving SoFi the multiple all of us would like to say.
Chris?
So, all right. So here's my response is, first of all, your numbers are dumb because they're wrong. I'm just kidding, but they are kind of wrong. So the reason why is because you're using GAAP numbers for your revenue. What happened in Q4 last year to SoFi that would have adjusted their revenue numbers?
Oh, no, Chris. You can't go by adjusted numbers. Adjusted numbers are ridiculous.
No, not with... You followed SoFi for long enough to know that their adjusted net revenue is more important than their GAAP revenue. And the reason why is because quarter four last year, they bought back a ton of debt. And that counted as revenue, even though it was just a one-time thing. That wasn't the core business. If you look at the actual core business, it's up about 32% year over year in Q4. So that's the first thing, is number one, is that the numbers are off. Number two, I actually agree with you that Robinhood has significantly more operating leverage than SoFi, because in order to scale crypto and in order to scale options, which is what drove the bulk of the revenue growth over the past year, they don't have to add anything to it, right? Completely and totally true. And so the fact that they're able to do that, they do have greater operating leverage than SoFi. Agreed. That doesn't mean that SoFi doesn't have operating leverage. And it's shown up specifically in the financial services aspect. So I don't know. Can I present just an Excel file?
Yep.
Probably
yeah. If you go just to window instead of tab.
So Chris,
Right.
While you're presenting that, if we go with your premise of not using GAAP and call SoFi's revenue 3.1 billion instead of 2.77 billion, it makes the operating margin even worse. FYI.
So no, what I'm saying is that, okay, we'll come to this. So
is that true or not true? Operating income
I don't
is
know.
operating.
I don't have those numbers in front of you. I do know that their
Operating
margins
income is
across the
220
entire
million.
board are increasing. Okay, so let's go through this. These are their incremental margins. So the way that this is year over year, how much revenue they're dropping to the bottom line every individual quarter. So from Q4 all the way through Q1, with the exception of so Q4 2022 all the way through Q1 2025, right? We're looking at incremental margins that are well above 30%. This is where they're going to end up in the long term, is incremental margins above 30%. The one time that it was below that is the fourth quarter of 2024. And the only reason that that one's so low is because in the fourth quarter of 2023, it was exceptionally high at 74%. It made it for a really, really difficult comp. So the point is, like, yes, I agree. Robinhood has better operating margins, but there's a lot of leverage in this business. Another one that I can, let's see, I'll have to zoom out and find the right one, right? But contribution margins, like this is their contribution margin. Sorry. Right? This is their contribution margin since the third quarter of 2022. This is operating leverage. They went from minus 100% margins all the way up to 40%, right? So this is the part of their business that is growing fastest. It's the part of the business that has the best operating leverage, right? It's the part of the business that has the lowest direct costs. This
part of the business is that, Chris?
This is financial services.
Oh, okay. So
could I also add?
So, but here's the thing: you're saying that it deserves a tech multiple, or it doesn't deserve a tech multiple.
I'm saying that it's a finance company, not a tech company.
Okay, but Robinhood is too.
I never said it was.
So if we're talking about tech multiples and we're talking about operating leverage, I agree with you that Robinhood's done an amazing job in the last year. But your point is that in order to get a tech multiple, you need to see rapid growth and you need to see margin expansion. And those two things are happening with SoFi.
Wait, hold on,
every
Chris.
single
Chris,
quarter.
why are you only showing contribution margins for one part of the business? Steve gave you operating margins for the entirety of Robinhood's business.
Yeah,
It still is.
Yeah.
I can show that it's still up and to the right.
No, but up and to the right is different than 38% versus 7%, which is what Steve's argument was.
You have to
Well,
go
to be-
by
to be
pure
fair, also,
profitability. You can go by
there you
net
go.
income or operating income.
If
Which
I
one
could
do you want
also
to go
add, the contribution margin that Chris was showing off was only Q3 of 2024. It actually gets to a 50% as
Oh,
of the
that's
most
true. I
recent
didn't
quarter.
Yeah,
extend
but
it.
again, I don't care about just financial services. I care about the whole business because Steve did not
Here's
show
the whole
me-
business.
No, it's not. There are expenses after contribution profit. That's
I
why
know.
nobody uses EBITDA or contribution profit. You use
Yes.
operating income or use net income. There
Yeah,
are
but-
reasons why you have taxes, depreciation, other expenses in a business.
Okay,
Op-
so
operating income margins, I think, should be the basis for this discussion. I feel
Or
like
you
that's
can do pure profit margins, either one. But when the street looks at GAAP numbers and when the street looks at earnings per share, contribution profit means absolutely nothing because
There you
those do
go.
not
There's margins
reflect
for the whole business.
EPS.
So everything's up and to the right. There's operating leverage across the entire business. They're not at their long-term run rate, but everything is up and to the right.
no, but their operating margins are 7.9%.
Operating margins fluctuate a lot for different reasons for SoFi than they do for.
But that's irrelevant to the like. I don't know why you're showing us all these random numbers. We're looking at something very simple: Robinhood's operating margin versus SoFi's. You can show us contribution adjusted EBITDA, but at some point we have to come to a
yeah,
agreement.
that's what's on the screen is just at the bottom there is just straight net income margin.
I get it.
Okay. So that gray line.
And
so
keep
even
in
though
mind, SoFi's net income in the TTM is what it is because they got, what was it, 270 million in income tax break in Q3?
No, this
I'm-
excludes that. That's the
Yes.
point. That's exactly why I said
that?
your numbers were bogus, is because your numbers included that
No.
number that was
Yeah,
just the tax
the
thing and
regular
the
net
buying back
income
debt
number
and everything
includes
else. So you're
that.
speaking out of both sides of your mouth, Steve.
No, I'm
You're
not.
saying,
Okay,
oh,
hold
you
on,
can't
hold on,
count,
hold on.
you
If
can't
you
count
take
the
that
the
out-
tax write-off.
If you take the tax write-off out, the net income is actually less and it's a smaller margin.
Right. And you should also take the debt repayment back when you're talking about year-over-year growth.
okay, so if we just use the gray line, that operating margin is what, Steve or Chris? What's the exact number?
I think it's like 9.7% or
Okay,
something.
Robinhood's at about 35.
8.7.
Robinhood's at about 35%. So the crux of the debate is 35 versus 9, right? Like operating leverage that creates the multiple because you're trying to prove to us SoFi is operating leverage.
Well, that's not what operating leverage is, but like you're just talking about a margin here. But SoFi's is ever increasing. That is operating leverage. It's getting better as more customers are being put onto the platform. Okay.
So why is the street not respecting it with the multiple is the question we're talking
That's why we're investors, because we think that the street is getting this position wrong.
Well, that's the crux of the debate. And the point is, Steve showed you guys Robinhood has basically 40% operating margins. Chris is showing us 9%, to call it 10%. There's a 30% gap there that is obviously influencing the stock prices.
Yes,
And so
but
I guess
you
the
saw
question is why?
something. You saw something in Robinhood whenever it was 8 that the street didn't.
You saw it before it was even gap profitable.
Right. And so what I'm saying is that
when it had negative margins.
we're earlier to that story than what SoFi is going to see. If they continue on this trajectory, they will hit those 30% and EBITDA above 40%. And then what? Everyone's going to look at it as a tech company then? What were we now?
No, yeah. When they actually put up the numbers, if they do, they will be seen as a tech company, and this won't be a debate. But
wouldn't it be a great investment to buy a bank that evolves into a tech company?
if
That's
you're
exactly-
right about this,
But that's
me
why
and Steve
exactly
are
why I
saying
showed you
this
the
might not play out.
incremental margins. You're
Yes.
asking, will they get to those margins? The answer to that question is, what are their incremental margins? Because incremental margins are where your actual margins end up hitting an asymptote. So right now, they are at approximately, like we said, 9% 9% margins. But if you look at their incremental margins, we're looking at things north of 30%. So they will, as long as they continue to operate the exact same way that they've continued to operate, then they will get to 30% plus net income margins. That's the point.
So right now, their net income is a 17.38% net income profit margin. Now, that will change this year And the reason why a lot of people don't like net income is because it fluctuates. But with banks, you can't use free cash flow. That's why Noto likes using adjusted EBITDA. He's explained that multiple times. So banks are valued differently. You can't use free cash flow because it's not really a real metric for banks, unfortunately. And that is a pure cash projection of a company because you don't have taxes, write-offs, that type of stuff in there. And the net income can completely change year over year, quarter over quarter. The difference right now is I have continuously said, and this is where everybody gets off track, that today, SoFi is not a technology company. SoFi is a finance company that utilizes technology to deliver its products. And the raw numbers are that technology segment, broken out by Noto and his team, not by Steve, is 12.63% of Q1's net revenue. I'm using net revenue numbers because that's what Chris wants to use. 12.63%, both of you know this. On a TTM basis, net revenue is 13.73%. It's 404 million and change. Net revenue is 2.94 billion. On a contribution level on tech, quarter over quarter growth, negative 3.72%. Year over year growth, 0.5%. Tech's contribution profit margin in Q1 was 7.39%, and in the TTM, 8.67%. Those are the margins. Those are the pure margins. Contribution.
So, you mean a percent? You mean when you say contribution margin, you mean percent of the total contribution, though, right? Not
percent of the total contribution profit, okay. Not net income. So in the TTM, Tech generated $127.13 million in contribution profit. And the total contribution profit in the same period was 1.47 billion. So the 8.67% margin. My whole argument is that technology is not the sole or predominant source of SoFi's revenue or profitability. And tech companies are classified as tech companies because that is the lion's share of their revenue. Until SoFi's technology segment, as they break it out, increases predominantly to tech, it will always be looked at as a financial service company. And that is why the street, the market, any other metric you want to throw out there looks at it as a financial company, because that is where the lion's share of their profitability comes from. Financial services and lending. And a loan platform is not a technology company. Many different companies have loan platforms, from agency-backed security companies such as Rim Capital, JP Morgan, Citibank. They all have a form of it. You want to go down BDCs, you want to talk about FSKKR, Blue Owl Capital, Ares Capital. They all have a form.
Okay, but none of
the loan platform.
But none of them, zero of them, are growing as fast as SoFi's loan platform business,
but once
right?
Again, growth is great, and growth is what helps gets the multiple. But lending is a segment outside of technology, and I love the lending platform. I want the lending platform to explode. But as the lending platform explodes and technology doesn't move, it's going to be looked at more and more as a traditional financial service company.
So if I could just quickly say, what makes the tech platform great? I would think that the tech platform would be looked at because of fast growth, or even better, high margins because it's a tech product.
Well,
but the tech
where's
platform,
the growth in tech?
The tech platform for SoFi is the lowest margin product that they have. Okay. The loan platform business, which is potentially their fastest growing segment of their business, which is under financial services as well, is also the highest, one of the highest margin pieces that they have, which is probably north of 60%, but it's part of financial services, so it's hard to break out, but the whole segment's at 50%. That's 20% higher than the tech platform. So why, just because it's called tech, do you think that that's the only part that's tech?
You're missing the argument. You're missing the whole thesis of this. Lending and financial service are traditional finance company businesses. Every single finance company lends. Every single finance company in the banking sector has checkings and savings and investment accounts.
We know
Tech
that.
companies do not have that. Tech platform, and the
what
way
makes that a bad business, though?
What I didn't hear.
Why would traditional financial services companies be valued lower than the rest of the S&P, or even lower than tech companies? Why
I'm glad you asked that, because traditional equities, you want to talk about Meta or Amazon, whatever you want to talk about, they do not lend off their balance sheet. That is not a primary function of their business. Okay. Nor are they allowed to do that. They will take equity investments in startups. They will take equity investments in companies. They'll make acquisitions, but they do not lend off the balance sheet. In order to lend off the balance sheet and generate that line of business, you need to be a financial institution, which SoFi is.
Well, no, I mean, you can lend a little bit. What if they're lending like 5%?
Tannor,
Steve,
what's the reason Noto got
what
their
percentage of Robinhood's income comes from their tech platform?
I have no idea. I don't follow
They don't
Robinhood.
have
Nor do
a
I
tech.
care about Robinhood.
They don't have a tech.
Zero. But you do care about Robinhood.
But I
You
never. No,
started
I
this
never.
whole discussion
said
talking about
Robinhood's a tech
Robinhood.
company.
I'll take this one. They don't have a tech
No,
platform.
wait. Let me respond to Steve and then.
Go ahead.
Okay. So here's your point. You said the only way that SoFi gets a tech multiple is if the tech platform starts to see growth. But Robinhood can get a tech multiple because they have growth. You can't hold both of those things in the same argument at the same time. Because if
you guys are
SoFi,
hearing what you want to hear.
I let you talk for like 5 minutes.
I'm just
and
saying,
every single time.
you guys are hearing what you want to hear. That's not what I said.
Okay.
That actually isn't what
Robinhood
he's
does.
Hold on, that
Robinhood has a tech multiple and SoFi doesn't.
So let me take this because that actually isn't what Steve said. And Chris,
Not what I said.
You made
You
this
guys are
argument.
hearing what you want to hear.
You made this argument many times on X, and I've tried to cordially explain it to you. So I'm going to try it again live in front of everybody. Robinhood doesn't have a tech platform. Robinhood uses Galileo for like less than 1% of their revenue, which is why you guys get excited about Galileo being the tech platform for SoFi. Robinhood doesn't have a tech platform.
That's not us. Come on.
That's a lot of the SoFi. Oh my God, they use this.
Yeah.
Robinhood has operating margins of 38% though. When Tannor says the operating margins of the tech platform on SoFi are the lowest in the business, that's a problem when you're trying to become a tech company. Now, your counter.
No.
Hold on. Let me finish.
No. It's not because their margin is bad. It's because the rest of the business is so good.
Well, the tech platform should be even better if we're talking about technology, right? So why is
That
lending
doesn't have
so
to be
good?
the case. That's just a definition.
We can see
Generally speaking, financial companies have higher net margins than tech companies.
Okay, so let me just finish. The reason why Robinhood's getting the tech multiple, outside of all the qualitative stuff that we haven't talked about, like Vlad actually, I don't know, talking to the public about his goals and his visions and stuff like that, is that crypto, for example, has incredible operating margins. And crypto did what, 350 million out of the 9, like so 30% of their revenues, right? So that's a risk because what if Bitcoin tanks? But the point is, when you have a business that has those types of margins in the context of crypto that allows those operating margins to get to 38%, I don't care if it's a tech platform or not, that is tech-like revenue growth and that is tech-like operating margins a la AWS. Or hold on, let me finish because I know what you're
That's
going
the
to say.
loan platform business.
Let me finish. A la Oracle, a la AWS, etc. Now, my argument here is that if you have a platform that is growing that substantially, whether it's Robinhood Gold, which is more of like their SaaS thing, or whether it's their crypto stuff, it's because the product is so good that it's leading to that growth and it's leading to those operating margins and it's leading to that net income to the bottom line. SoFi does not have that. Now, you may be pointing to the margins on the loan platform being good, but right now it's not showing up in the bottom line. And maybe it will show up in the bottom line in the future, but it's not showing up right now. The tech platform absolutely is not showing that right now, and we're not really seeing that tech platform growth. The qualitative part of this is very important because you might be saying, and I can see it in Tanner's face, wait a second, Amit, the lending platform is going to have all those operating margins just like Robinhood's crypto platform does. Therefore, if crypto is not technically a tech platform and lending is not a tech platform, why is crypto getting this multiple for Robinhood, but lending platform and this referral-based fee thing is not getting a tech multiple for SoFi?
Well
and
said.
that goes back to Steve's point, which is that lending is a traditional banking service. And
So is
No,
a
it's not.
brokerage.
Yeah.
Well, I was specifically talking about crypto, not the brokerage. That's kind of because crypto, 30% of the, like, that's kind of the core point right there. So my point is, if the street is giving a multiple on crypto because of how juicy the margins are, but they're not giving a multiple on the lending platform, maybe that's because, and I'm not saying this, perceptually, the lending platform is not viewed as something that's super amazing and it'll grow. Maybe it does in the future, but right now that's not the case.
But it's not just Robinhood's not a crypto platform. They're giving the multiple to options. They're giving a multiple to equities. They're giving a multiple to its general growth.
Yes.
SoFi is growing at 32%. Okay. Their specific parts of their business, like the loan platform, are essentially doubling what seems like every 2 quarters. Like, I mean, it's very, very fast growth.
And none of that is coming to the bottom line is my point. That's why
Yes,
we
it
talked
is.
about
Why is it not? Why is it not?
At least not
What's the
yet.
net
If you look at
income?
the operating margins, it's not happening yet.
Did
What do
you
you-
not see?
Dude,
That's
the operating
funny.
margins are 8% or 10%. Robinhood's at 40. It's not happening yet. Maybe in
The
Where
loan
was
platform-
Robinhood 1 year ago?
Yes.
1 year ago is not today, Chris.
and things have changed.
Yeah,
Chris.
but where
Yeah.
was Robinhood 1 year ago?
That's exactly what I wanted to talk about with Steve's chart as well. You showed 5 quarters. 5 quarters out of the entire business. If there's 2 things that give companies multiples, we see this either from Nvidia or we see it from Costco, is the speed of your growth, the margins, that the pricing power on top of that, and then it's also the actual sustainability, the consistency of your growth. Consistency on Robinhood is, I mean, I love the company, but it's worrisome of if they are going
I
to
agree.
double next year or stay flat.
I agree with you. And that gets into the qualitative parts if you want to have that discussion.
that is-
why I think it's getting a multiple, but I agree with you. It's
But
cyclical.
that isn't in the negotiation for SoFi, is it?
Share
Well,
this,
so-
Tanner,
so-
please.
Go ahead, Chris. Go ahead.
No, share the screen. Okay, so this is Robinhood. I don't have them labeled, right? It's blue is SoFi, red is Robinhood. They both came public in the exact same quarter, right? This is their growth over that time. SoFi has gone from just over 200 million all the way up to 800 million. Robinhood went from 600 million to just under $1 billion in the last quarter. Overall, if you talk about consistency of growth, SoFi is a better business has been, right? A
I
better
agree.
business
I
over the
agree,
long
by
term.
the way.
Now,
I agree.
I totally think that Robinhood is doing an amazing job in adding to their breadth of products so that they can smooth this out and not have a 40% down year over year like they did in 2022. They got hammered in 2022, right? And this is kind of a bigger picture problem that I have with a lot of what gets talked about when it comes to Robinhood, when it comes to SoFi, when it comes to this comparison, is there is a lot of recency bias in everything that gets said, as if 2022 didn't exist. During 2022, Robinhood dropped its revenues 30% and SoFi grew 50% in the exact same macro. Okay. So the point is, and I think Robinhood's done a lot to make their business more robust, more resilient, able to grow. They're expanding internationally. They're killing it. They're doing a great job. But the point is that people come around and say ridiculous things like SoFi can't grow and SoFi won't grow. And yet they've had 30% plus revenue growth every single year over the last 4 years. Like, that's really resilient and that's really robust. And they've done it in a lot of different macros with a ton of different headwinds. They got, you talking about crypto, they got crypto stripped from them, not of their own free will and choice, but because the regulators took it away from them. They had the highest rate hike cycle in like ever. In 2021, when we started this, they had the student loans taken away from them, which at that point were their biggest business. So the point is that they're agile like a tech company. They pivot really, really well like a tech company, and they show resilient year over year over year continuous growth like a tech company.
So, Chris, I could not agree with you more that SoFi has done an exceptional job, and we can even go a step further and say that they fought 3 years with one hand and one leg tied behind their back because no other company had to endure what they endured. And I don't think another management team could have managed their way out of the situation that SoFi was in. Not to their own fault. They were forced into a very bad situation, student loans, everything else. I don't know who you're talking about. I'm going to assume you're not talking about me because I've never said that SoFi can't grow or it's not growing, because I have put in writing on Seeking Alpha every time I'm still bullish because of their growth rates. It's a growth company. My whole argument is it is not a information technology company. It is a financial service company. There's a big difference between the two.
I think we both agree with you.
Agree.
Yeah, we agree. I just think that financial services companies can get tech multiples because we've seen Robinhood do it.
Of course
Yeah,
they can. But they have to have the correct margins to do it. And right now, SoFi has to prove it and get there. They're not there yet. And
but they proved it every quarter in their incremental margins.
They prove it in incremental on straight line, but on bottom line, they're not proving it. They're not there yet. And for the market to get that perception out of their head, several things need to happen. And I would not be going down this road because I just started this tirade about 2 months ago because Noto opened his mouth and changed his communication to, instead of being a top 10 finance company by market cap, he opened the door to say that they want to be a top 15 company by market cap in IT. Noto said that, not me. And that's what made me change and go down this rabbit hole. And in order for them to do that, they have to deliver on the AWS of fintech. Otherwise, that does not happen. And it does not look like, from the way that they are reporting, that there is a shot in hell that that happens. And that is why I've gone so hard in the paint on the whole technology thing with SoFi. Not that it's not a great company, not that it's not expanding margins or growing rapidly, because it's doing all those things. But the bottom line is, it is a finance company, not a technology company. The lion's share of their revenue, the lion's share of their profitability comes from traditional finance metrics. Period. End of story. That cannot be refuted.
Well, I think it absolutely can. There are
Lending
companies.
and financial services is pure play banking.
Look at
So we
Nubank,
agree-
pure play banking.
I
I
we
think companies
agree.
get multiples based on their growth and the margins. And you can say that a bank can be held back from a strong multiple because what fits them best would be a tangible book value or book value in general. But that's because people can look at the overall book size of the business and say, okay, they can only leverage themselves up because there's a cap on the amount that they can limit them or leverage themselves. So the law will restrict them from growing their loan size too fast. That makes sense. But SoFi is ever increasingly being less reliant on their loan growth, right? And we see that in the percentage of overall fee-based revenue. So whenever SoFi goes from 75% loan revenue to now getting down to, I think it's like 50% right now, they want to reduce it or even more. They want to get to about 70% overall fee-based. Wouldn't you think that the book value can expand past what it's currently sitting at?
Of course it can.
But that's
once
multiple
again,
expansion.
it needs a couple of quarters for that to expand in book value. It absolutely can expand. We've seen it start growing. But let me ask you something. What lines of business is the fee-based revenue coming from, Tannor?
Financial services mainly.
There you go.
And tech platform also, but financial services mainly. So Steve, we agree. Like, here's the thing. Like, the thing that I don't understand about your argument is that we agree that SoFi gets the bulk of its revenue from financial services. Like, everyone here knows that that's a fact. We get it. But then you're saying Robinhood deserves a tech multiple.
I never
because
said
it
that.
gets.
No, that's more a myth side.
I said they're getting a multiple.
Okay, Robinhood's getting a multiple. Okay,
Because they're margins.
we'll
That's
take
all
out the word deserve, right? Robinhood's getting a multiple because they are exhibiting operating margins and because they're exhibiting hyper growth.
That's all.
My point is, SoFi is also doing those two things. They're a couple quarters behind. But the thing is that the other, both Palantir, Robinhood, all these other companies, they re-rated before they showed their final margins. And the way that you can see where the margins are going, this is why I led with that incremental margin graph, is because you can see what their incremental margins are. You can see what the operating leverage the business has. And that's one of the things I look at in all of the growth stocks that I look at, is that incremental margins, because I want to know where those margins are going to end up in 5 years.
And that's where I agree with
you. Look at the incremental margins.
And Chris, I agree with you 100% in what you've said. And I've said very similar things for the past several years. SoFi's growth is incredible. It's always been very good. It's always been strong. And they've done everything they need to do. The problem is right now, when the market is looking at the margins, is perceiving them as a certain type of company. My entire argument has been, if they want to get the market to perceive them as a different type of company, and I only started saying this recently because Noto said that's how he wants to be judged, so now we have to judge him by that. They have to do certain things. They're not doing those. And I made a little chart while we were talking about net income margins. And right now, look, SoFi's net income margin is growing. And I'm happy about that. But once again, it's not resembling a tech company. And
you're just too early
finance
here.
Companies are still better margin companies on a net basis.
You're comparing 9 very mature businesses to SoFi here. That's all this is.
traditional businesses that have, as you like to call it, brick and mortar that makes them banks.
No, I see a lot of non-bank like companies up here.
Well, yeah, tech companies.
Yeah.
Like at tech multiples.
Yeah, the problem is, Tanner, if he put Hood on that graph, it would say 40%, which is rivaling Meta. And so,
But where did it say? Where was Hood last year?
Yeah.
why?
I agree with you.
How is that
SoFi's not
relevant?
there yet.
So, but
Sorry,
that's
go
the whole
ahead.
point of the debate, right? Like, and I hope they get there. You guys know I got some options. I will make a lot of money if they get there, because then the stock probably gets closer to that $15, $18, $20 range. But the whole debate is, will they get there? And you're saying they're a couple quarters behind. I think they've had an incredible 2 years in terms of growth. I have nothing against the company. My argument is, as a market participant, why is the stock market not perceiving that? You could just say the market's stupid. That's fine. But the market tends to be right over the long term. So what is going on right now, 4 years after IPO, where the market's saying we are not buying this? And how many quarters away is it? 2026?
Tanner, bring it up again. I want to show you.
Timeline here.
Okay, so I don't think that SoFi should have been valued where it was at IPO. So I think that there was really high multiples at the time, big SPAC craze, really pumped the stock up high. I was not a buyer in the $20 ranges back then. So I'm talking about the company now, and I believe that they should probably be somewhere around double the stock price of where they are today. Well, around 25, I'd say. But I'm not calling for them being 25 4 years from now at all. That's a different story.
I don't think anyone is. But if this debate is pointless, if you're like, well, just give it time, SoFi will get there. It's like, okay, then like.
Well, I think it deserves it right now, but it's not getting it. The same way
why?
that you.
Why do you, Chris? Why do you think they're not getting it? That's my question.
So, for a plethora of reasons. Number one, people use this as I think people use SoFi as a hedge against the macro. Like, I think that's one of the reasons for all the short interest. And the reason why, and I've heard this from lots of people, is that the market will shoot first and then ask questions later when it comes to their loan book. They do have what lots of Wall Street analysts and hedge funds think is very aggressive accounting with their fair value accounting. And we've been down that road with other people. We don't need to go down it again. But because of that perception that they have this aggressive accounting standard, they think that SoFi is going to crater and tank and go into bankruptcy if we have a turn in the macro. Okay. A secondary reason why is because of what Steve's talking about, where people say, well, banks get valued on their tangible book value. Like, you read all of the Wall Street analysts on this company, and all of them have, like, they will have this long thing, and then they'll go in and they'll say, this is how we're valuing it. And they will value it based on a multiple of the tangible book value. They will get everything about the company wrong. They will get the deposits.
It doesn't deserve the multiple because JP Morgan has a similar multiple and 50,000 analysts. I mean, even people on the panel get it wrong.
Well,
like, so I guess the point is that, like, they think that the growth is going to be limited by the book. And you can obviously see from the numbers, that's not the case. If the growth was limited by the size of their tangible book, it would have stopped growing at the end of last year. It would have stopped dead in its tracks because its capital ratio has been the exact same since that quarter. So the point is, the growth, they are growing their lending revenue, but that's just because they're growing their tangible book value over time. So,
and because they're also able to sell off, so they can actually grow faster than potentially traditional large companies like JP Morgan that wouldn't be able to flip their book at the rate that SoFi could because they're much smaller.
So I agree
realize
with
that
you.
SoFi doesn't loans on the balance sheet for sale, correct?
Sorry?
You do realize that JP Morgan has loans on the balance sheet for sale.
Of course, but it's not as the percentage of the overall
percentage,
like SoFi's is.
Steve?
Oh, it's a very small percentage. I'm just making a point that
What percentage is SoFi's?
SoFi's is pretty high.
Like 90%. I don't know the number.
And SoFi does have a very good LDR ratio, which I am very happy about. It's like 65, 67%, which is great because that's what you want to see from a finance company. That means they're not overextended. The question that I have for the two of you, so I have a few things I want to address. But the first thing is, why do banks get valued off of book value?
I just told, so the reason that banks get valued off of tangible book value is the only first principles reasons to think about this is the fact that typical banks, most banks are only able to generate income based on their tangible book value. Warren Buffett actually has a great clip on this where people asked him about, this was way back during like 20 years ago. And they asked Warren Buffett about valuing banks. And he said, banks shouldn't be valued on book value. Banks should be valued on net income like any other company. But the reason that most banks end up getting valued on book value is because that's what limits, it's the return on their book is what limits their earnings. So from a first principles perspective, the only reason to value a bank on its tangible book value is if that statement is true. And it's been proved demonstrably false in the case of SoFi.
So put SoFi aside, because I'm not asking about SoFi. I'm asking a very generic. No, Tannor, don't give me that face.
Well, we're talking about SoFi here.
I'm asking a very generic question about why do banks get valued off of book value? And I agree with what you said, because I think that companies should be based off of EPS, net income, profitability, and other things. But the facts and the way the market values finance companies, one of the main factors is off of book value, because you're buying a book of assets where they are lending off the balance sheet to generate lending interest income. That is a predominant line in banking. That's a fact.
Why don't we value SoFi off of free cash flow?
You don't value any banks off of free cash flow.
Yeah, why? Why not? Normal companies are valued at free cash flow. Why is SoFi not?
It's just not something that they do.
And SoFi should not typically be valued off tangible book value either.
What is SoFi's free cash flow?
Well, it's based on them selling loans. What I'm saying is that it's not applicable to SoFi the same way that tangible book value is not applicable.
It's like minus $1 billion.
But Tannor, you can't say that's not applicable. And I'm glad you said applicable instead of applicable, like some people. Like it drives me nuts when I hear that. When people say, when anybody says it other than applicable, it drives me freaking nuts. But anyway, I agree with you on how I would like companies to be valued no matter what industry they're in, because I think there's tremendous market inefficiencies. And Costco is a perfect example of that. And we can go all night on that. And I hate it because it is insane that people are willing to pay 50 times their earnings, but not 22 times Meta's. It's nuts. But anyway, we're higher growth rates. But the reality is that right now, and this could change in the future, but I'm talking right now, present day, traditionally, banks get valued predominantly off of book value for those reasons. That's a fact. It is traditional finance, and that's how they get valued. I'm not saying that's a good thing. I'm not saying that's a bad thing. I'm not saying that should be how it is. I'm just saying that is the way that it is, that they get valued off of book value. And I've always said, for SoFi to break that mold and to get the multiple that we would like to see, they need to prove to the market that they are more than a traditional finance company. And the combination of Technisys and Galileo should put them in that position. But in order to do that, they have to prove that they can cross-sell that and generate the incremental revenue off of the software stack, because that will give them the hybrid multiple. They have been unable to prove that. And the argument is that Noto said top 15 tech company by market cap. And if you want to get there, you have to show that you can power the other competitors' tech stack through your platform. They sign the contracts and you're generating the revenue and net income. Otherwise, the market will perceive SoFi as a finance company. And that is why SoFi is not getting the multiple that we would like to see. Whether we agree that it should be or it shouldn't be, those are the facts. The market is not perceiving it.
Those are not facts. That's your opinion. That's not those.
That's not opinion.
It's not an opinion.
It needs an AWS versus just a fast-growing company. Look at
it's a fact that it's not being valued as like getting the same multiple as other tech companies.
But your equation for how they get there is your opinion.
Is that the only reason it's not is because the tech platform.
Well, that's the point of the debate, guys. That's why we're
debating. The debate is it a finance company or is it a tech company? Is it a bank or a tech company? Which one is it? That's the point of the debate.
It's a technology
finance company.
So I just want to say one thing, and then I want to say you guys are saying growth at all costs means multiple. All Steve and I are saying is growth is all costs is great. But if the market's perception of the type of growth is not tech oriented or whatever you want to call it, then it's not going to get that hyper multiple. That's all we're saying. And I don't know how you can disagree with that, because that's what the market's been saying. And maybe in 2027 that changes, 2026, I don't know. But right now the market does not believe the lending platform or the banking services, any of that deserves a multiple. It's just that simple.
Right. But the market in 2023 didn't believe Palantir deserved a multiple, and they were dead freaking wrong.
Wait, but things happened. We had a AI revolution, and Palantir started growing like crazy with a tech product, and they had a rule of 40 of 83. Like,
Okay, and what is SoFi's rule of 40?
I don't know. Let me know.
It's around 60.
Okay, that's fine. So that's good. I'm happy for that. But the market doesn't care, right? So like now the question is, okay, admit the market doesn't care right now. Maybe they'll care later. Sure, but how much later then? I mean, I don't know. Is it tomorrow? Is it in 4 years? Because for Palantir, it took a couple years, and we can kind of see why. For SoFi, does it take 5 years? Does it take 5 months? I don't know. But the point of right here, right now, I can't debate about Palantir 2023. All I can say is the market does not think it's worth anything.
This is absolutely not what we were talking about the other day. Is what is the market thinking about SoFi right here and right now? It's, hey, is this something that is worth our money as investors?
Okay, so then
is the market going to continue to give it that multiple?
You can roll back the tape on every SoFi weekly that I've been on for the past 2 months. That's exactly.
I'm talking about the conversation that the three of us had.
Yes. So can I actually give my reasons? So I asked Chris why does he think the market's not giving SoFi multiple? I want to give my reasons now. I have a couple of reasons. So first off, Robinhood doesn't say there's a tech platform part of their business, which is actually just interesting. I just thought of this right now because they just have, transaction revenues, interest revenue, others, etc. That's the parts of the business. SoFi, not Steve, not me, not you, not Chris, decided to say we're going to segment a part of our business as tech. Why? Because they have a banking charter and they know they need to show other parts of their revenue that are tied to that banking charter. If you listen to Vlad when he was asked on multiple podcasts, hey, why don't you get a banking charter? Even Vlad was like, dude, it kind of sucks to have a banking charter because all the regulators. Let me just finish.
They had a tech platform before a bank charter, and Robinhood also went after a bank charter in 2019 as well.
That's exactly my point, Tanner. And Vlad got to the finish line. He was 2 steps away, and then he was like, "Holy crap, the regulator's going to be."
That's not true at all.
That's exactly what he said.
They didn't get anywhere near a finish line. Let's be real.
I am quoting Vlad on Tevis's podcast 2 weeks ago, saying we got.
He didn't say he was 2 steps away.
He almost verbatim said we were very close to getting it, and at the last moment we realized
they were very close to starting. That's what it was.
Okay.
Again, go to Tevis's thing.
I tend to get into these very semantic discussions, and you guys are not really getting the point. The point is they didn't want a banking charter because they realized it would drag them down and they would be tied to their balance sheet. That is actually a fact, that the way the market is interpreting SoFi is, hey, they're attached to their banking charter, even if you guys want to debate it. Robinhood doesn't have that, liability on the perception of the stock. That's the first thing. Number 2, and I've been saying this for a long time. It's going to piss some people off. I quite frankly don't care because it is what it is. Anthony Noto does not inspire people. He does not inspire the masses. He does not inspire anyone to kind of think creatively about what the world can look like. And everyone who's a super big SoFi bull and looks at all the numbers will be like, Amit's just in love with Karp, in love with Vlad. He doesn't really get the fact that markets are based on numbers, etc. I would say a lot of Palantir's multiple has to do with the fact that people believe in Alex Karp. A lot of Robinhood's multiple has to do with the fact that people believe in Vlad's vision of $85 trillion of wealth being passed down to millennials and Gen Z from the boomer generation. When Anthony Noto on a podcast with Liz Young was asked, what is your BHAG? For those that didn't go to business school, BHAG is a big, hairy, audacious goal. His answer was, I don't want to say it because our competitors might copy us. And I'm listening to that and I'm thinking, oh my goodness, this is not a tech CEO. Because Karp said, we're going to take the fucking market. Vlad said, I don't really care what you guys do. We're going off to the races. When I see a CEO say, I don't want to say what our big, hairy, audacious goal is. This is what he said, not what I'm saying. This is what he said. Because people might copy us. Right then and there, I'm like, what Wall Street executive, what hedge fund manager is going to be listening to them and be like, man, I trust that guy. Which, by the way, a lot of us invest in people because we trust them. A lot of retail investors don't even know what the contribution margin is. They just like, I like Karp. I'm going to trust and believe what he's doing. And I don't think I've gotten a proper response from anyone in the SoFi community for the past 4 years when I've been saying, hey, this guy is not really inspiring. And this is a qualitative metric that, yes, it's not going to show up in the adjusted EBITDA numbers, but it matters to the stock price. No one has an answer to that. Third thing, they don't do any product events. They don't actually inspire people in the context of, hey, they own a freaking stadium and they don't do any events. I think they kind of have a stadium. They can maybe rent it out for an hour. They have not done a product event, not done an investor day. Robinhood's about to do their 3rd one this year. You might say that's silly. That doesn't warrant a tech multiple. I would say, most tech companies like an Amazon, a Meta, a Palantir, they have events which doesn't characterize them as a tech company, but most tech companies that have technology to show off want to show it off to the world. They're not afraid to show it off. They want to have these events. They want to spend some of the marketing budget to say, hey, We're not just going to put our name on the NBA logos. We're not just going to put our name in the Los Angeles Stadium. We're actually going to invite people and show them our products. Every single tech company Apple, they kind of started this. The fact that SoFi doesn't do that doesn't mean they're not a tech company. It means the perception, which is what we've been talking about, is not rooted in the technology sector. Final thing I'll say, SoFi does not give monthly active users. And I will die on this hill. They have 11 million members. I reckon a lot of those 11 million don't use the damn product. And if you're going to tell me that 11 million members is amazing growth, Tannor, every time you say, well, Robinhood's only getting 500,000 users a quarter, SoFi's getting 800,000, how many of those people can they actually upsell? Can they actually monetize? Can they actually say, hey, this is an active user? Why is it so hard to disclose for a baby tech company at 15 billion? Netflix stopped doing it because Netflix is a $500 billion company. When they were a $15 billion company, you bet your ass they disclosed how many subscribers they got a quarter and how much watch time they had. Why isn't SoFi doing that? I think it's because a technology company actually shows the usage of their tech. And if you want to define the usage of a monthly active user as paying their deposit or auto paying their loan, that's fine. That's not technology. That's a bank. And I think the culmination of what I'm trying to say is the ethos, the persona of this company is nothing like a Palantir, a Robinhood, a Amazon, a Meta, a Google, etc. And for that reason, from a qualitative perspective, that's why I think they don't get a tech multiple.
To start on your monthly active user thing, I'll let Chris take the other ones, the product launches and stuff, which I just think is communication issues, which I also agree with you. Is that SoFi doesn't benefit from monthly active users the way that Netflix or Meta would, right? Meta, people who are on their site actively produce them money because they're looking at ads, they're using the app more. SoFi, whether you're on it or not, if you're paying off your loan, they're making money from you. You can tap your card and have auto pay through your checking account and direct deposit all set up. You don't even need to open the app. It'll run seamlessly fine.
So why aren't they disclosing that then, Tannor?
Because they just don't, it's not a metric for their business.
No,
if
but
you look at the metrics that do show off how active their customers are, you'll see average revenue per user, you'll see average revenue per product per user, or any of these statistics. And by the way, they still have churn on their user base. So you can see as users fall off, whether they're passing away or inactive accounts or whatever, they do show churn. But the products that they do have, you are seeing more usage.
And all of those are banking products that the street's not going to give a multiple to, which is why I'm saying
Multiple's giving it to Robinhood for their MAUs. And by the way, their MAUs were so much higher in 2021 at like 21 million users. Now it's like 13.4 million.
Yeah, so if I was Vlad, I wouldn't want to disclose that. I would be kind of scared to show that drop off. But I don't think
that's what I mean.
You still have to show that to your investor base.
No, but it's absolutely useless. It doesn't show the quality of Robinhood's business.
So hold on. If SoFi has 11 million members and 500,000 of them are active a month, and active we can define in whatever way, but if that was the ratio, is that a useless number for investors?
What number do you think it is?
I don't think it's damn near 11 million. I'll tell you that.
I don't think many banks have activity rates of 100%. I'd say Nubank's probably the highest. It's got 84%. So like,
what do you think it is? How many people do you think actually check SoFi every month? Forget every day.
I don't care. And here's the reason why. Put up the chart.
I don't care at all.
The numbers you show are not going to define what matters.
I would love for SoFi to disclose MAOs. Why? Because my moniker is data-driven investing. I want all the data all the time on every metric. That would be great. Here's why I'm not worried about it, is because of what you see in front of you. Okay. On the left is the average financial services revenue per member. On the right is the total of lending and financial services revenue per member.
Can you bring up the lending one as well? Do you have lending separated as well?
I don't have lending separated.
Because they're all going up, but the only reason why because it's the mix of lending to financial services is why it's going down. But they're both going up.
Here's the thing. Individually, the financial services is going up, the lending is going up, and all told, with the mix shift, it's coming down just a little bit. If what you were saying is true, so I hear your argument. The issue is that your argument isn't like, it's a good rhetorical argument, but it doesn't actually have to do with the facts. These are the actual facts. The facts are that they're getting more ARPU per member every single quarter. So if they went, and this was from, it was like 2 million members in second quarter of 2021 to 11 million members. The fact of the matter is that they're members are just as lucrative today as they were years ago. So that's why I'm not worried about it. So I agree. I would love those things. And I think that you're right that SoFi has a communication problem. And I think that there's lots of things that they could do that would be low-hanging fruit to do better messaging to investors, to do better messaging to their clients, to do better messaging to their members. I agree with a lot of those things.
Chris, does a tech company disclose their MAUs?
It doesn't matter. Only if
Wait,
the
that's not my question.
MAUs.
That's not my
Wait. Let me
No,
answer.
that's not true.
No,
Amit.
let me answer. Only if the MAUs affect their revenue and their net income.
Well, I have a fundamental. First of all, that chart on the right does not look like there's that much.
How many MAUs does
first of all.
Salesforce have? I'm curious.
I don't know. But my point right here is that when you're a $15 billion company and you're trying to show the world, you take the chart off the screen so people can see me. When you're trying to show the world that your consumers are engaged. See, this is the creative part of this stuff that I think the SoFi people, they're not getting. Creativity is defined as like, do people actually open the app? Do they have a feeling? When I was at the Robinhood Gold event, one of the engineers showed me and Tannor the haptics of the screen, aka the vibrations of their new Robinhood Strategies product. That is like such intense level to user, a level of a dedication to user experience and design and product. And as a result, they're happy to disclose that 14 out of the 25 million members they have actually are on the app every day. When it comes to upselling, when it comes to cross-selling, I think you have to be active to use that. Everyone on the SoFi Twitter community is screaming about when crypto's coming and when options are coming back. Options level 1. Why? Why do you guys care about crypto? Why do you guys care about options level 1? Because it's going to drive engagement. And engagement is a function of how many people are actively using it. And if you seriously tell me a company with top 15 tech market cap ambitions doesn't have to disclose how many of their 11 million are actually using it, but then you want crypto for engagement, but then you want options level 1 so people can go back on the product, that means you're ignoring the fact that the product, the tech part of the business, the stuff that people need to use every day, is not getting the type of usage that's required. Now, the lending part is, the banking part is, the checking part is, the auto pay for your loans are, but those are all bank types of services that are not getting a multiple. And it
Robinhood
is
is a
asinine to me that
series-
no one sees what's happening here.
Robinhood is a series of banking products as well. And you're just saying, okay, they're getting a whole bunch more usage in checking and SoFi Invest in credit cards and all of these things, but that doesn't matter at all because they're financial services products.
Tannor, what would it sound like if I was raising money for AK Media and someone's like, how many people watch you live every morning? I was like, oh, just don't worry. Don't worry.
That's because your
source.
revenue
Don't
is
worry about it.
directly affected by the number of people who show up and watch your stream.
So SoFi's
SoFi's revenue is directly affected by the number of members that they had. That's why I put up the chart. Here's the thing. You go into these debates and you make these esoteric points and you say them as if they were fact. And then I put up a chart that says what you said sounds good, but it's not actually true. You can chart their revenue by their members. You give me their membership number next quarter, I can give you their revenue. I don't need MAUs to do that.
Well, no, but you're this is where you are. I might be esoteric, but you are way too data driven. Because when it comes to actually analyzing the market perception of, is SoFi disrupting JP Morgan? Is SoFi disrupting? Are people like using this? Is this actually growing into something? You can show me a chart of revenue per member that's going up and to the right. That's great. But if you don't show me that there is something in the cultural zeitgeist where people are posting screenshots every day when a stock is going up and down of Robinhood indicating usage, if you can't show me that for SoFi, and you're only pointing to checkings and savings gets usage and auto pay on your loans gets a usage, which increases the revenue per user, Chris, I'm not dismissing that argument, that increases your revenue per member, that is a bank that is going to get a banking multiple. That is not going to enter the zeitgeist of what people use every day because maybe the product is not good enough to use. And that's why I want MAUs. But apparently that's too esoteric.
No, I told you that I want MAUs too. So here's my issue. I agree with you on a lot of these things. I'm critiquing little points. And the point is that you're saying that in order to get this, no, I totally agree with you. I think that they fall short when it comes to things that they could do that are low-hanging fruit that would better capture the zeitgeist. Totally agree with that. I think there's a lot of things that they could do that would really improve that. Okay. But at the end of the day, if we come back in 5 years and we look at this debate and we look at what the market has done, the most important thing in investing in this company is going to be what happened to the revenue, what happened to the net income over those 5 years, right? I agree with you that, Karp going off and talking about the hedgies and talking about tendies and everything else that he does, right? It does excite people. I kind of do disagree with you about whether or not Noto is a motivator. I think that, and Steve, for example, one of the key reasons he actually invested in the company was the Stanford talk, right? Like when you listen to Noto speak, sorry, what?
I just said Steve can talk. He's just all hand motion.
He said his piece earlier. He'll have more to say later, I'm sure. But one of the main reasons is Noto is actually very motivational, which is why I actually think it would be a really good thing for him to speak more to retail, for him to get on more events. Like I am 100% in agreement with you. I would love to have them do product launches. That's not their style. Like I've talked to Noto about this, and I agree with you that it would do a lot for the business and it would do a lot to energize investors and all those things. And I also think that it would help the multiple. I agree with all of those things. But what I'm saying is that doesn't determine whether or not it's a tech company.
Yes, it does. Yes, it does.
5 years down the road, it's not going to matter that much to what happened to the stock price.
You cannot agree with me about all these different things that are qualitative, not quantitative, and then say, well, we'll visit this back in 5 years. Because first of all, we're not talking about 5 years. We're talking about today, why it's not getting multiple. If that's the case, you agree. Like, there's not even a debate. You agree with all of the reasons Steve and I have laid out for why this stock is not a tech company today. 5 years from now,
well, that's a very big generalization to say that I agree with absolutely.
But you just agreed that communication would really help. You just agreed that product events would really help. You just agreed that Noto not shying away from his big, hairy, audacious goal, like an actual tech CEO would just say, fuck it, we're going to take over the world. Not saying, oh, I'm afraid to say that because our competitors. You agree that would be like a good thing for him to go that route. All of those things, in my opinion, would help the multiple because we have two very obvious examples in front of us, Vlad and Karp, that have been able to get their multiples to be pretty aggressive because of their communication, at least to an extent. If you agree with that, then right now SoFi is not a tech company because they don't have a leader, which, by the way, there's a CEO in this company that is getting the market to think they're a tech company.
But I don't care as much about that. Go ahead, Tannor.
I do. That's the difference. I do.
I honestly admit, I think that your investing strategy throughout your investing career has benefited you by finding companies that have leaned into that sort of community-based, hyping up the investment, this sort of thing. It's worked for you. And so you're going to look for more investments that follow that same style.
Real quick, Tannor. I'm going to let you finish, but it has not just worked for me. It's worked for the stocks. Let's get this very clear. It has not just worked for me because the retail meme
but there are companies.
They've put up the growth along with having charismatic leaders that has led the stock to appreciate. Just want to get that out there.
I wouldn't consider Mark Zuckerberg to be a charismatic leader. I'd think him to be a sort of a weird kind of water drinking lizard that everyone kind of thinks is a little buggy and weird, but yet he fundamentally puts up unbelievable numbers every quarter.
I agree.
So
I'm not saying the leader I'm not saying the leader is 100% of the reason. I'm saying at this stage of a life cycle of a company, $15-20 billion, they're a pretty big damn part.
I think that it would be additive to the business if he did product launches and investor days and talk more to retail. Very biased in that opinion as well.
Me too.
Yeah. But I don't think that he even has to in order for it to get a tech multiple. I don't think showing up on stage makes a tech company. I think operating leverage, hyper growth, just all the things that make a tech company, which I actually wanted to go back to Roy's comment back before, because he actually brought up a good point that tech companies usually have a big focus on R&D. Okay. It's actually a pretty easy way to separate them. SoFi puts up R&D the same way that Robinhood does. And they are consistently trying to push for the future products that will engage members that potentially JP Morgan, Wells Fargo, or Citi is not doing. So I like, whether we talk about it being a tech company today or in the future or anything like this, I think SoFi has been very consistent in their strategy.
Do you really want to go down that road?
Go ahead.
Do you really want to go down that
Just bring up your example.
No, I've been typing to the chat the entire time listening to you guys, but you just made a fatal flaw. If you really, I'm going to let you retract what you said.
I'm not going
to. You know you're wrong.
Dude, you did this last time to me. You're like, oh, he's going to really hate it. And then you said you're buying more NVIDIA and that it's going to be the biggest company in the world. So I'm going to let you just Pull
Brought up-
your show your cards.
Keep going.
I think when you brought up R&D, Steve's going to bring up JP Morgan's R&D budget. And it's like, my point about R&D is like, dude, this is ridiculous to me. Oh, SoFi spending a lot on R&D. Where's the development? There's no level 1 options. There's no crypto.
Those are the products that you guys are looking for.
Yes, but the Galileo shit that you're looking for is not resulting.
No, I
in
didn't
growth.
say that. I didn't say that. So
What
how
R&D
does SoFi,
are you talking about?
how does SoFi go from 7-day funded loans to 1 day to same-day funded personal loans? And then you try to find companies that are also doing that.
I got news for you. The market doesn't care about 1-day funded loans or 7-day.
The market doesn't care.
That's why they're growing 30%.
Yes.
And the market doesn't care if that 30% is because of 1-day funded.
Their
loans.
customers the customers who are taking out loans care, and that's who they're trying to.
Oh, the customers care, but the market does not care if the research and development of SoFi Technologies is about 1-day funded loans.
We agree that perception is stronger than reality, but what matters to me is actual reality and not the perception of it. Because in the long term, where the company ends up being valued is based on reality. Because if we have this conversation in 2 years, right? If we have this conversation and in 2 years, they continue to put up 30% growth and they continue to have the same incremental margins in 2 years, just like 2 years ago when you were having this conversation with Palantir, you could see what was coming. I can see what's coming because of the way that they're doing this, because of the growth that they've had. If they have another 2 years of 30% growth and 30% incremental margins, then we're talking about a company that's got, or greater than 30% EBITDA margins, right? Close to 30% net income margins. Now we're talking about a company that has 30% overall margins. And now we're talking about a company that's now continued to grow for an entire decade at like a 30 to 40% CAGR. And at some point, reality sets in.
But Chris, that's in the future. That's 2 years from
Yeah,
now.
but I can't control the market. I can't control when the market gets it. I get it now. The data is there now. The growth is there now. The member satisfaction is there now. The member retention is there now. The products are there now, and they're continuing to grow. That's all reality right now.
Amit,
But the market doesn't get it, and I'm fine with that.
What's also reality is the stock, right? And like
you could say all these same points about Grab.
no, you can't. And I might be wrong on Grab in 2 years. My price target is $10 by 2027. I'm gonna have to take it like a man if I'm wrong about that. But my point is in the here and now, it's been 4 years since IPO. They've grown way better than Robinhood, as you showed the charts, because Robinhood was so cyclical. But the market's not caring about it after every single argument you give me quantitatively, which I'll give you are really good numbers.
And qualitatively.
No, but they've also improved. Like, let's not discount it that much. The market has gone from 1 times tangible book value, or even lower than that, to now 2. So we've doubled in like the last, since Q3 or Q4 roughly, once they started showing off the loan platform business.
Yeah, but compared to the market, SoFi going from 7 to 13, which by the way is a great return, right? And a lot of people should be happy about that. Is not comparable to other stocks in this bull market. Now, the question is, from the SoFi community that I read the tweets on every day, they're upset. They want this to be 20, 25, 30. People are saying it should be 45 by now, 35, at least 25. If that's not happening, and you're telling me it'll happen 2 years from now, then let's have this debate 2 years from now. But in the here and now,
you don't even believe what you're saying.
No.
You had a weekly Palantir show when it was trading at $7. On that show, did you come on every week and say, "Man, the market is right. Palantir is only worth $7 a share because that's what the market says."
The difference is we acknowledge reality. Palantir cannot sell their product. They sucked at selling. They had no distribution. And Steve, myself, Sachin, all of us like, man, this shit's got to change. And it did with boot camps.
And here's the thing: SoFi never sucked.
Well, hold on. I'll even say
sorry.
They went through a bad macro where their loan sales had to go to essentially zero. Student loans were stripped away from them. Okay. Then tech platform right now is their tail, or is their sort of headwind right now. But all the loan sales are coming back. They've got the loan platform business that's coming back. The entire back end is now transferred over to Technisys. And so now you're seeing them ramp up in all these new product ideas. Who's to say that, the products that we've been expecting, that ramp is going to come in 2025. They're expecting level 1 options, crypto, all of these things this year.
Look, if it does, I'll be happy. I've got SoFi options. That's why I'm still in this. I'm not
but
shorting
that's
it,
a
right?
cop-out. That's a cop-out.
No, it's not. No, it's not. If I was actually super like, man, SoFi's stuck at 13. I think I should have brought this up earlier. I would not have those options. If SoFi goes to 20, I'll be very happy. So if I even goes to 15, I'll be happy. And if I was really, if my words were so aggressive against SoFi, the stock, I would be shorting it or buying puts on it. I'm not doing that. My point is just in the here and now. You guys are telling me look at the future. Okay, then in 2 years we'll look at the future. But in the here and now, by the way, it's been a 2-year bull market.
Successful quarters are right now.
It's been a crazy bull market, and the stock market has not given SoFi the multiple. That's the crux of this debate,
Dude.
And we're talking about
3x from the bottom, Amit.
Yeah, well, it fell from 25 to 4, and now it's up 3x, which is great. Not a lot of people bought it for. A lot of people bought it 25. You can say the same thing about Robinhood.
I didn't buy it. I'm not advocating for the 25ers.
Down to 6. Like, my point is, if you compare October 2022 prices across the entire market, a lot of stocks.
Put a poll in your chat and ask how many people bought it 25 and how many people bought it 4.
No, you're missing my point. My point is, yes, from the absolute lows from 4 to 13, it's done great. And no one should be upset if they have a $4 average. But relative to the opportunity cost of the market, I know you talk about opportunity cost a lot, Chris. In the next 5 years, if SoFi is 70, 80 bucks, you're going to say, screw the opportunity cost of 2025. Look at in 2035, I have an $80 stock. I have 20,000 shares. I'm good. I'm just saying right now, the whole crux of this Saturday night debate is, why is the market not giving them a multiple? And I think I've at least outlined my points from a qualitative perspective and from a quantitative perspective. If the operating margins change, my opinion will change. If Noto starts actually talking to his biggest supporters and not just doing podcasts with Liz Young, my opinion will change. But those are real issues, like fundamental.
But you don't care about the financials or any of the things that they're actually putting out. You care more about the podcast that he's doing.
No. I do care about the financials. And when I look at their operating margins compared to Hood, I have at least quantitative explanation for why there's a difference. And if you want to tell me, oh, well, the lending platform, you're not paying enough attention to that, I gave you my argument. Maybe I'll be wrong. But my argument is the market doesn't care about lending. Maybe I'll be wrong. I don't know. I don't decide SoFi stock price. The market does. So I don't even know how you can debate the market doesn't care about lending. The market doesn't care about lending. Maybe
the market doesn't care about lending right now. I mean, you guys were saying the exact same thing whenever it was 7, and then 1 month from there, I was having the exact same conversation at 18 about how freaking genius Noto was. So I'm saying, don't let the market dictate how you see SoFi. The numbers are here. Like we can see whether or not you say that their operating margins are good or bad. They are ever increasing. They've been all the way from extreme negatives into the large numbers that they're going to bring in next, and that is as clear as day. Like if a company can do something for just quarter after quarter after quarter, regardless of the macro environment that they're in, it's hard to deny that they that I'm speculating or guessing into the future.
I 1,000% agree with you. I don't disagree with anything you said. All I'm saying is, if the market at this moment of time is not recognizing that, then that's the crux of the debate. That's why we're having if the SoFi was $25, we wouldn't have this debate right now. It wouldn't matter because the market would have recognized it. Like, the reason we had Pouncer Weekly for 3 years is because at 7 to 8, we were like, why isn't the market getting this? And so we analyzed it, and eventually the market did. Maybe that will happen for SoFi, but you guys are telling me the market should recognize it right now. Steve and I are giving you reasons why maybe there are some aspects to this company that the market is potentially getting right, and saying an uninspiring CEO and a business that's primarily growing off lending and banking services is not something worthwhile for our capital. And maybe that'll change, but that's the present, at least here right now.
Steve,
right. Can I address a few things?
Yeah, sure.
Okay. So I feel like we're discussing multiple different things. And once again, I want to be very clear before I go through the laundry list of everything that I heard, that my take on this has been that the market is not giving them the multiple that we want to see because the market does not perceive them as a tech company. The market perceives them as a bank, and banks traditionally are valued in a very specific way. And until SoFi proves them wrong, it will be very hard for them to get a valuation that we would like to see. That is very hard to refute because that is actually happening. You can't refute, so don't even talk.
I agree with you there. I didn't come on here to argue the market's perception of SoFi. You guys are saying how their financial services products were
on SoFi Weekly, and I say SoFi is not a tech company; it's a finance company. Everybody jumps down my throat. The chat's like, you don't know what you're talking about. Everybody tries ganging
Yeah,
up
because
on
you
me.
name the amount of engineers that JP Morgan has, as if that matters at all.
Of course it matters. So let's go down a few things. So first, Salesforce. MAUs with Salesforce is irrelevant.
No, it's not irrelevant. They're a tech company. Come on. They're a tech company.
Hold on.
Tech companies tell you their MAUs.
Hold on.
Tech
Hold
companies
on,
tell you
hold
their
on.
MAUs.
Can you guys stop?
You guys let me fucking speak.
B2C tech company.
Period.
Oh,
not
you're changing
B2B.
it now.
Period.
If you didn't understand that a B2C tech company that actually has monetizable users is what,
Jesus
like, come on,
Christ.
dude. Enterprise
We're
software.
just
is not what
busting
we're
your
talking
chops, Amit. We're
You
just
guys
giving
fucking
you
let me
crap.
speak.
I'm busting some chops back to make sure we know what's going on.
Okay, the reason MAUs do not matter for Salesforce, which they have 26 million of, is because it is B2B, like Amit said. But the
So they show
difference.
total users. They just don't
Hold
show
on,
monthly actives.
Hold on.
All right.
I'm gonna get really mad, and when I get really mad, you don't want to see what happens.
All right, Cowboy.
Is that the LeBron meme? Is that the LeBron? Okay, no, seriously, let's Steve talk. Let's Steve talk.
Go ahead, Steve.
All right.
Steve,
Salesforce.
wait, Steve. That kind of turned me on. I'm just saying.
Jesus Christ.
That kind of turned me on.
So-
Okay, go ahead.
Salesforce is a much different company. They only have business clients. They do not have consumer clients. So a average user has a much higher rate of what they are paying. Two different things. It's not applicable to the conversation. Period.
We know it was a
individual
joke, dude.
user is using Salesforce. It is a corporate platform. And the way those contracts works are much different. So you can't bring that up. First point. Second point, Noda. Chris is right. The reason that I bought into the company was because of the Stanford speech. And Noda should talk more. And he should go on individual podcasts. Chris should interview him. Tannor should interview him. Amit should interview him. Tevis and Roy should all interview him one-on-one. The fact that Noto does not talk to his base is ridiculous. And the only time you hear from the guy is during earnings, on the earnings call, and then when he goes on Bloomberg and CNBC that day, and when he does a fireside chat that 1,000 people listen to. The problem with that is nobody's listening to the fireside chats because nobody even knows that they're happening. Tannor and Matt, they get way more viewers than those fireside chats do. Noto is doing a disservice to the company by not being more public facing, because I do agree he can inspire people when he wants to. The problem is he doesn't. Now, for Noto to come out on the Liz Young podcast and say that he does not want to discuss what the roadmap is because he doesn't want people to copy them shows that there is not a moat in these areas. There is a huge moat in their tech platform, which they're not monetizing. And it drives me nuts that they're not monetizing it yet, because every other thing that they're doing, every other finance company can do it. Now, whether we want to discuss how they can put it out, what's better, what's quicker, what's cloud, what's not, that's semantics. What we know is no other company owns the back end the way SoFi does. Between
Pretty techy.
Technisys and Galileo, no other company owns the back end the way that they do. And when you combine that into a single core platform, there's tremendous tech potential there, but it's not showing up in the numbers yet. And we need Noto to really go through this and explain it. But he gets softball questions from analysts who may or may not go as deep as the three of you into the company. And it would be better for the three of you to interview him than get softball questions from the analyst community who don't understand half the business. We've seen it time and time again. Look at the guy from Wedbush who had a $2 or $3 rating on it. I mean, these guys don't understand the business the way you guys do. So Noto does a disservice with that. The idea that we are not going to show the market what we're going to do, you will never hear Elon talk about that. You'll never hear Karp say that. You never hear Zuckerberg say that. You never hear Nadella say that. Alphabet just had a tremendous corporate viewership thing with their whole platform for AI on their investor day.
Google
that
I/O.
changed the market's perception. Apple does it every year. Whether it changes the market perception or not, you know what's coming with their developer conference. All of these companies do that because they know that they can put out a product that is very hard to replicate, and they don't care about talking about it. Now, Noto, that's a problem. And when I hear, and I am not a Robinhood fan, okay, I'm not. But when I hear Vlad come out and talk about we're going to do business banking, we're going to do lending, we're going to do 401ks, we're going to do all this. We have a 2-year roadmap. Watch what we do. And Noto sits there and says, I don't want to show you what we're going to do. Somebody may copy us. That's a cop-out answer that makes me question things. They need to have an investor day. They need to show the roadmap. Now, as far as active users, SoFi should be reporting active users. Here's why. I have a SoFi account. They make no money off of me. I have 5 or 10 shares of SoFi in there just so I could own SoFi in a SoFi account. Now, they would love for me to move all my business there. They would love for me to have my direct deposit there. They would love for me to have my savings there. They would love for me to do my brokerage there. I don't use it for anything. So they're not monetizing me. And I am sure that there are a lot of people, maybe not a lot, maybe a few people, handful, that have it for one product and they're not cross-selling or used it for something and aren't really using it. But they really should show how many active members they have, because that would tell us, look, if they have an 80 or 90% active member base, that would be incredible. I would love that, because that means that they will be able to cross-sell people, because that's the whole flywheel argument about SoFi, that when they get people into the environment, they're going to be utilizing all the different products throughout their way of life. I mean, it's incredible. Zuckerberg, hold on. Zuckerberg, don't ever say the guy's not a leader. Like, how dare
you? Didn't say he wasn't a leader. You said he was a water-sipping lizard.
Yeah, the same way I wouldn't say that Noto is not a leader either. He is, but he's not on podcasts all the time. That's all I'm saying.
Well,
Zuck is a leader, but he's
okay,
also.
I thought I heard that Zuck is not a leader. I take that back. I apologize. Okay, R&D budget. Okay, now granted, I will give a lot of leeway on this because SoFi is a younger company. Okay, but when you look at the non-interest expenses of SoFi, it's 2.55 billion. Okay,
the absolute numbers.
Of course, absolute numbers. It's I look at numbers. Like, this is what we have to go with, numbers. Citigroup, 53.95 billion.
Mm-hmm.
JP Morgan, 92.72 billion. These companies are spending massive amounts of money. A lot of it in R&D, a lot of it in tech. Also, to Tanner's point, operating legacy branches, which we can have a debate about whether that's a good or a bad thing. It still serves a purpose in today's world. A lot of things can be done with cloud, but there are certain things you still do need to go into a bank for. And while that is becoming less and less, there is still a need for that. Now, Palantir. I personally think Palantir is very overvalued. My opinion doesn't matter. I've been wrong.
We're getting off topic here.
No. We started comparing.
Steve is just cooking.
We started.
That's what the chat wants. The chat wants Steve to keep.
It is unfair to look at it like that. But when you look at the growth rate of SoFi's growth rate is great, and they need to continue to do what they do. But they need to be more transparent about the other things that they are going to do and that they want to do. And part of the problem is Noto is sitting there talking about tech and this and that, but they're not showing us in the numbers. And we all are invested, or most of us are invested, because we believe that SoFi is going to be a much bigger company in the future than it is today. The core of the argument is that today, the market is not treating SoFi as a different type of company, and it is pigeonholing it into a financial services company because the majority of their revenue and profit comes from financial services. And in order to break that mold, and in order for SoFi to get out of that, they have to change the market's perception. Now, whether they do that in 2 years from now is irrelevant, because they very well may. But right now, they are not doing that, and Noto is not doing enough to change the perception of the market. And until that changes, it will be very hard for SoFi to get a different multiple than what they are getting, because based off of traditional finance metrics, SoFi has already expanded the rubber band of where they would be, because they're already past 2x book value. And there's only one other bank that is past 2x book value, and that's JP Morgan, for a very good reason, because they're generating $60 billion in net income. They're buying back a ton of shares. They pay a big dividend growth.
We already talked about Amex, Adyen, Nubank, a whole bunch of other companies that are banks that trade well above their tangible book values.
Amex, and while you are correct, and they are technically a bank, Amex is not classified as a bank because their predominant line of business is credit cards.
How about Nubank?
I don't really follow Nubank, but that's emerging markets.
That's a
I would
cop-out.
say that that's a bank, not a technology company. It's financial services.
I think they're at a 7 book value right now.
What are they trading at?
7x book value.
7x book value?
Yeah.
I'll look into it more. I really don't follow them. But
The one thing I'll say about Nubank real quick, and I don't know them that well as well, but they're hyper growth compared to SoFi, from my understanding. Could be wrong, but they're growing a lot more. B, Latin America, emerging markets, and like them being a pseudo monopoly in Brazil, I think paints a little bit of a different narrative than SoFi, which is one of thousands of banks in the United
So
States.
growth can determine a higher multiple, is what you're
If you
saying.
are a
It
monopoly
can.
in an entire country, sure, Tanner. But when
Okay,
you're
well, they were
one
doing it
of
back whenever they
you're
had
one of
book left.
7,000 banks in America,
so,
it's a little different.
Tanner, yes, growth can create a higher multiple, and growth should create a higher multiple, because when you are growing quicker, if you have good margins, that means profitability is going to compound quicker. But right now, SoFi's margins and their top line growth are too disconnected. Now, whether that is because they are dropping only 30 cents to the bottom line and 70 cents to R&D, we understand that, but the street does not understand that. And what they are seeing is absolute numbers, and they're looking at forward projections. And once again, the street is looking at them in a certain way. And
Okay.
that's been the crux of my argument.
Now I want to. I'll go. Just say something really quickly. Here's a company that's B2C that really their lifeline is determinant of users being active. Where's Amazon's MAUs?
Tanner, Amazon is a $2 trillion
Tanner,
Tanner, it's a
you want to go down that road?
You're
$2
embarrassing
billion
yourself
company.
with this example.
Tanner, you're embarrassing yourself
Like-
talking about stupid shit like this.
They have a massive tech multiple.
Tanner,
They have
Amazon
an
is a
advertising
Whoa.
business.
I don't even know
Whoa.
if I want to respond to that because a
No, I'm gonna
$2
respond.
There's no answer.
I'm going to respond to it. So, Tanner, you want to say Amazon has a tech multiple? Where's SoFi trading on EPS versus Amazon? Tell me that.
Well,
and then tell
it's
me, and then
different.
tell me they have a tech multiple.
It's at a different stage of the company.
Yes,
That's not
completely
But I'm
agree.
that's
not the
not
one that said that
the
they're getting
worthwhile
it.
comparison.
Tanner's the one that's saying it.
Why-
you show
Tanner's
me
the one
they're
who
getting
brought
it.
up Amazon, and now we're saying we can't compare.
Yeah.
I'm curious where all their product launches and all these things are. I mean, they kind of just
Are
whenever they
you-
put out their products, they kind of just
So, Tanner, do you
them under
listen
the
to
rug.
There's
them
no
on
way
this
you're at.
road? Do you listen to anything with them? Like, you want to go down this road, bring up the
You realize
multiple
AWS
other-
is the biggest conference every year, right? Like,
Yes,
you're not saying this,
but-
right, Tanner?
but
I know you're
they're
not saying
not-
this.
Okay, hold on,
but he's
hold
not
on.
going on
Hold on.
podcasts with YouTubers.
Oh my
Jassy,
God.
actually, Jassy is doing like Jassy, Jensen, Zuck,
SoFi
Elon,
is
all
SoFi
of these guys
is
are doing podcasts, Tanner.
SoFi is going on the technology conferences that AWS is hosting. Why would they put a bank on their technology platform?
Tanner, let me ask you something. I want you to respond to 2 or 3 things. Okay. So you have a computer in front of you, obviously. Tell me what SoFi's current PE of 2025 earnings is.
Dude, they're
No,
brand new
you,
to
you
making
brought
money.
it up. If you're not going to tell me what it is, I'll tell you what
It's
it is.
probably
So
like
would you like to
60 or
say
70, something like that.
47.64
Yeah,
forward PE.
They're
So hold on.
What's its peg,
Amazon
Steve?
is trading at 33 times this year's earnings. So you want to say that Amazon's not getting a tech multiple? Well, I mean,
Just
I don't understand what you're
I
saying.
like what Chris said. What's their peg?
Who cares what the peg is?
Well,
It's got
prices in their
48%
growth.
forward growth, and it's going to trading at 22.9 times 2027. I mean,
Amazon's getting a much more aggressive peg. It's like 1.5
This is why this
or something
example
like
is
that.
so stupid. Like, I can't even believe we're comparing this right now. Like,
No,
this
I'm
is-
just saying that
This
you're
isn't a
saying that
worthwhile
like
conversation. I'm
companies
with Amit on that one.
companies have to be looked at a certain way. I just don't agree. Like if it's not fundamentally driving their revenue, which it is actually for Amazon because their advertising division and everything like this, but for SoFi, MAUs does not drive their revenue. That's a pointless metric.
Dude,
you're right. Active users drives its revenue.
How
What
is
does?
upselling and cross-selling not a function
Active
of
users drive SoFi's revenue.
They
Hold on,
need.
hold on,
Selling
Tanner.
and upselling does drive it, Amit, but MAUs does not.
No, but people have to be active. Like, correct me if I'm wrong, but I have to take my phone and I have to like press the SoFi app and like be engaged with it at least every month. Forget every day, forget every week, at least every month to be able to have a chance.
My parents check their bank account like once every 6 months. Schwab has made ridiculous amounts of money off of my parents.
And guess what? Those are banks that are getting banking multiples. So if you're saying SoFi only needs people to check it once every other month, then the street's not going to respect that.
No, but you are making a false equivalency, because you're saying the reason is because they don't go in every 6 months. No, the reason why Schwab gets the multiples it does is because their growth and their net income are limited by their book value. And so you can look at the book value and you can see how much growth they're going to have. Okay. SoFi's not. And here's the thing. I agree with you. Like, I don't know how to express this properly, apparently, because I've tried to multiple times and it's not coming across. The MAUs would show you, I'll try this way. The MAUs would show you the same thing as the revenue growth.
Yeah.
Because we know the average revenue per member, and we know that the average revenue per member is flat. So
We
I
know
can
the average
infer,
loan sizes.
I can very rationally infer that if it was 20% 2 years ago, it's probably 19% or 20% again right now. Right? So the point is that I have a metric that I can use that is correlated to revenue growth. And that's what I care about. Like, I care about whether or not the membership. So again, yes, I do want to see MAUs. I'd love to see it, but I'm not losing sleep about it. And I don't think that it's worth, like,
I'm not talking about what I feel or what you feel. I'm talking about what the market feels. And if Meta in 2012 IPO'd without explaining their MAUs,
Robinhood is not getting a multiple because their MAUs is on their 44th page of their presentation.
But Robinhood,
pointless.
But Robinhood's disclosing it.
If Robinhood was giving a multiple based on its MAUs, it would be 50% lower than it was in 2021.
But yeah, look at this. Look at this. Total revenue for Robinhood. That's what it looks like.
This
goes back to MAUs. How do they correlate?
Your fancy charts and your Excel sheets are not getting to the point. My argument has nothing to do with ARPU. And you can scoff your head, you can roll your eyes all you want. The last time I checked, there's a difference between those two stock prices. The reason MAUs are important is because, as I've said so many times, people using Robinhood is correlated to an extent, maybe not proportionally, maybe not directly, but to an extent, with how the market thinks of Robinhood. I mean, Tannor, that guy we met, I think his name was Vincent at the Investor Day, the guy who was in The Big Short, he was running some hedge fund or whatever. When we were walking with him down the street, coming from the Investor Day, we were like, hey, what do you think about SoFi? Vincent Daniels. We were talking about, he was like, what do you think about SoFi? He was like, dude, SoFi. He's like, that's the future. You just saw the future. And because there's something culturally relevant about that product. The Roth IRA, the fact that so many people that are unemployed like myself can have a Roth IRA inside a Roth, there's a cultural phenomenon there that can't be measured in your charts. And you need to know if people are active. And MAU, like even if Robinhood didn't disclose MAU, we would know that there's a lot of active users. My point on SoFi is I don't think there's a lot of them. And if they are, I don't think they're actually engaging. And your average—
If they weren't, then they wouldn't be generating revenue. It would be impossible for them to generate revenue if they weren't doing anything.
Sure, but that ARPU is not growing to the point where the market's like, oh my God, we need to give this a tech multiple because everyone's using SoFi. If it's a couple million out of the 11 million, that's an issue.
It's
really one metric going up into—
That's a false statement.
Can we stop calling it a
not a
tech
false
multiple and just say giving it a higher multiple?
Yes.
I agree with you. I agree with you.
Sure.
Look, my point, like, forget the MAU debate. We don't even have to talk about that. But there's other qualitative parts to SoFi that I think you both have agreed with matter. And if you both agree that Noto needs to be a better communicator, then I think that's one point of a conclusion we can all come to. Like, Steve and I can come to the conclusion that if the tech platform starts growing and operating margins, even without the tech platform, gets to 40%, yeah, this stock probably should get a higher multiple. Like, I think Steve and I both agree with that. And I think you guys both agree that Noto shouldn't shy away from talking about his goals. Those are like points of agreement we can come to, and eventually we'll see how the market thinks of it.
We agree. I also think those are easy things to fix.
Absolutely, they're easy things to fix. Problem is that he's not fixing them.
And you have to ask yourself why. Why is Noto?
I think I know why, but
why is he not talking with you, Tannor? Answer that question. Like, why do you think?
I think that he, because of the comments that he made about business banking, that he's trying to get in very good with regulators. Now, I'm not trying to pull back the curtain, but there are other businesses who are shying away from retail to help with compliance. Okay. This is potentially happening a lot where we do put a little bit of compliance risk, and they'd rather go on TV shows that are more reputable than on YouTube.
So Tannor, and I do agree with you that could be a very big reason why You know what he could do instead? SoFi's got a headquarters. They have conference rooms. They have video conferencing equipment.
They've been hiring for this.
He can very easily from his office give a live on YouTube and go through the whole thing. He hasn't done it. He doesn't need to meet with anybody. He can do it on his own right now if he wanted to. He's not doing it. Every other company shows you the flywheel and shows you the forward products that they're looking to launch. How long has Benioff been talking about Agent Force? And when you start looking at the data from this quarter about Agent Force, it's incredible what it's doing. How long has Workday been talking about agents in their ERP? How long have these companies been talking about this stuff? Vlad, what he said, Zuckerberg about what he said, all these CEOs, they're wartime CEOs. And I'm not saying that Noto doesn't have it in him because we saw him be a wartime CEO. I want the Noto from 2022 back. We don't have
I personally
that
would
Noto.
not call Vlad a wartime CEO. I would call Noto a wartime CEO.
I just said that Noto was a wartime CEO in 2022, and that's
No,
the
but I
Noto
think you
want
gave.
back.
Yeah.
He's not going on the offensive. He's not getting the market excited, and he's not showing people where the true value in SoFi lies. And while we all, I believe, do see where the true value lies and what the true potential is, it's a lot different with us seeing it than the market seeing it. And the problem is the market doesn't see it, and that's reflected in the multiple it's getting, the share price, why the share price isn't moving. And in order for them to break that, they need to change that cycle. And it's just not happening.
And I think, Chris, you and Noto are actually very similar in this respect, where your argument is, hey, the data is showing things are going up and to the right. The market will respect that. I think Noto honestly thinks the same. He's like, why do I need to talk to freaking Tannor? Or, like the market will eventually get it. And maybe that will be the case. But as of now, I don't think it would be the worst thing in the world if he talked to the people that are talking about his company. And maybe that would, maybe I'm wrong. Maybe he does a podcast with Tannor, nothing happened. Maybe no one cares. But the point is, at least I'm suggesting something. Whereas you guys for the past couple of years have been just saying the charts are going up and to the right, but the stock hasn't followed as aggressively. And maybe it will.
And we would all like it to. The problem is that it's not. And because it hasn't, and look, every quarter is a triple beat, except for usually Q4 because they have to issue guidance for the next year. So it can't be a triple beat. It can only be a double beat. But how many times have we seen a triple beat pop and then sell off past 4 or 5 quarters? I mean, it's incredible that the market just doesn't respect it. And you have to ask yourself why. And their only conclusion at this point, because everything Chris said in his data is correct, with the way that SoFi is growing, everything that they're doing, they're hitting the nail on the head with everything. But the market doesn't care. And at some point, we have to call a spade and ask why. And the reasoning is because traditional finance companies are traditionally valued in a certain way. And right now, SoFi is being pigeonholed. And it's going to take more than what they are doing now to break out of that mold. Now, maybe they break out of that mold next week or next month, but today they're not. And that is the problem. And that is why I have been saying that when Noto comes out and says that he wants to be a top 15 tech company, I was on board. I put it in writing on Seeking Alpha. When he used to say top 10 finance company by market cap, I supported it and said, I truly believe he can get there. Here's the things that he needs to do to get there. And the things that I have said have not happened, from business banking to wealth management to 401k administration, because they can cross all the products. They already have a full ETF suite. They can turn that into mutual funds. They get their expense ratio off the funds. Then they get the management fee off the asset management from the wealth management division, from companies, pension funds, 401ks, everything else. That would drive book value tremendously. We're not seeing any of that. And it is just a shame that we are in a situation that we are in, and the market is the one that is showing this, unfortunately. It's just very hard because we all see the potential. But at this point, the market is not respecting it. And the majority of their revenue does come from financial services. That is not debatable.
Can I ask if it just continues to compound at a 30% rate, can it just stay unrespected indefinitely?
So the definition of unrespected will change if it continues to compound, because the book value will grow and you'll start to see the share price rise. But
No, as a multiple, I mean.
I'm getting there. You may not see the large multiple that you would like to see if it was classified as a different company. And we all know, you take a company like Cloudflare, you take a company like CrowdStrike, Palo Alto, any of those companies, they all get tremendous multiples because they're in a different sector. Now, I hate that because I wish everything was black and white and it was off of earnings growth, revenue growth, because to me, it doesn't matter if you sell a widget, software, or a tire. If you generate $1 million of pure profit, you generate $1 million of pure profit.
I agree.
I wish the market worked that way, because if you have a 20% growth rate year over year, in year one, you're growing $200,000 pure profit to the bottom line. There are certain metrics that I wish the market just went off of. Unfortunately, we don't, because there is a perception that tech companies have the purest play for the most growth. Now, whether that is true or that is not true, that is the market's perception. So while Noto now says that he believes he's going to be a top 15 tech company, we're not seeing that in the numbers because tech represents such a small percentage of what their overall numbers are. And what I've continued to say is that for them to be considered a tech company, tech has to represent a larger portion of the revenue and the contribution profit. That does not mean that SoFi cannot grow, have a bigger share price, grow their tangible book, and get a bigger multiple. But in order to do that, they have to sustain and grow the growth rates, because it will be harder if they're classified as a financial service company than if they were considered a tech company. But because their lion's share does not come from tech, the market will never look at them as a pure tech company. Those are facts. You
Okay,
look at any mutual fund.
Let's kick it off to
where they put SoFi in, they will put it in financials, not
okay. You're repeating yourself.
I
ahead,
never
Chris.
said that before. That's not repeating myself. You pull up any mutual fund that SoFi's in, it will show that it's in financials.
Go ahead, Chris.
We know. Okay. So let's, rather than rehashing, so I do want to talk a little bit about, like, Noto is actually a very inspiring person. I agree, again, that he should go on other things. But here's the thing, is that, like, I think that Tannor has a point when he says that there are, and this goes back to what Amit was saying earlier, right? There are certain things that come along with having a banking charter that make it more difficult for him to probably do those things. Like, I think it bothers him to no end not being able to say the things that he wants to say. I don't know why. And you're right, Steve, that he could go and he could set something up in his thing. He's also, like, at some point, though, he is the CEO of this company and he gets to choose what he gets to do. And I trust him in order to actually execute and do the things that I expect SoFi as a business to do. And there was some other thing that I wanted to talk about, but it's been like 10 minutes since then, so I completely forgot what it was. Along those lines about, like, Noto doing those types of things, right? But the thing is, he's actually, like, when you listen to him speak, he has a vision that's actually really, really helpful, or that's really inspiring. And he is an inspiring speaker. If you talk to, there's someone, like, in our X group chat who used to work for SoFi, and he says that that Noto is the one person of all of his bosses and all of his CEOs that he would run through a wall for and run. And, like, I trust management because they continue to deliver. I trust management because they continue to put up numbers. And at some point, right, like, at some point, revenue, this is one of Steve's favorite things that he always says. He says a dollar of revenue is a dollar of revenue and a dollar of profit is a dollar of profit. And at some point, those dollars of revenue and those dollars of profits add up. And you look at the company and you think, here's its long-term margins. You can see they're obviously going this direction. Here's its growth trajectory. It continues to put up these numbers in spite of the fact that it's not limited by its tangible book value, because tangible book value has been, or their capital ratio has been flat forever. There's lots of things that you can look at, right? And at some point, the market will realize what reality is. I agree with you. Like, but the thing is that, like, we've been talking all night about what the market thinks and, like, about perception. And, like, that just bothers me because I don't care that much about perception. The fact, wait.
That's what the debate was.
Chris, go ahead.
Here's the thing. That's exactly where you find alpha in the markets, is when you find something that is inaccurately valued. And that's why I think SoFi has that value, is because I have looked at it, I've studied it, I've done the DD, I know where it's going. I am very confident. I could be wrong, right? I absolutely could be wrong. But the fact of the matter is that they are like, their membership growth is exponential, right? The last 2 quarters have been their highest member growth ever. It's continuing to grow. Every single time they bring in a member, I know exactly how much revenue that person's going to bring. And I can continue, I can count on that happening. And you can like, the exponential is going to happen. And as that happens, the market has to reward it at some point. I think right now, based on all the DD I've done, like Tanner, this is at least a $25 stock that's sitting around $13 in terms of the value that it brings. And that alpha is what I want to invest in. I don't want to buy, like, I have Palantir shares. I'm not adding to a Palantir position right now because, you know, of its valuation, right? Exceptional company doing amazing things that nobody else can do.
And Chris,
But SoFi is also doing things that nobody else in the industry is doing. Nobody else who offers the breadth of SoFi's products, nobody else who does this can grow like them. Nobody has grown like them for this many years. It's like there is no comparable business. Affirm is the closest.
So, look, I agree with pretty much everything you said. And you want to find companies in the market that are inaccurately priced. And while the market is always right at the time, it can change on a dime. And you would rather
And
be
it's
there
not
first
right.
than last.
That's the point.
No,
The market is
hold on.
not right if it can change on a
Hold
dime
on.
and still be right.
Right now, the market is right and we are early. Now, whether that takes a week, a year, 2 years is a different story. We don't know. We can't predict the future, but we all believe that at some point, the narrative is going to change and SoFi is going to make a lot more money for us because the share price is going to be higher. You've done the due diligence. I've done it. Tanner's done it. Mitt's done it. We see the vision. I think that we've been, you and I have disagreed on certain things, which are different than what you and Mitt have disagreed on. But when you talk about looking for alpha, I agree. I look for things that are mispriced. That's what Citibank, I was buying the shit out of it at 40. SL Green, I was buying the shit out of it at 20 because of market inefficiencies. And the market was pricing it a certain way. And there were people selling it at that price and buying it. Now, the debate or the point that I have been making for the past several weeks revolves around, is it a tech company or is it a finance company? Now, saying not that I don't care about what the market thinks of it is fine. That's your prerogative. But the facts are that right now, and it may or may not be correct in the future, the market is pricing it a certain way, and the market is not perceiving it as a tech company. That has been the fundamental point that I have been going after for the past several weeks because of what Noto's previous comments were. I put something in the private chat. I don't think that we can show it, but I think we should distribute it if we can, because this is one, it's not the Stanford one, but this is, to Chris's point, Noto can be very inspiring. And this is one of the best interviews that people have never really seen. I think Tanner may see it because he's smiling.
Well,
but
look who posted the video.
I have not, who posted it?
Me.
Oh, honestly, I didn't even know that. I just typed in
He's like, I don't know
Noto
if
Bank
you
of
can show
America.
it. It's my video.
Bro, you're a fake ass subscriber, bro.
Dude, you think I looked at who posted? I looked for the supercut video, but it's a video where he outlined why acquiring Technisys was so important and how they were going to combine it with Galileo and what the future of banking was going to be. But he hasn't talked like that in so long. And when you stop talking like that and stop reminding the market of what you're doing, I mean, this is one of the best interviews he's ever given. I mean, I don't know if we can watch it right now or not, but it is incredible. But people should watch this. Go to Tanner's channel and watch it. This is one of the best interviews he's given. He hasn't talked like this in 2 or 3 years. And part of the problem is the market continues to pigeonhole it. Now, Chris is probably right. At the end of the day, this will probably get a different multiple in a year or 2 or maybe 6 months from now as certain things happen. Today, it's not getting that multiple. And the reason is for what I have outlined. Now, that can change. But today is what we are talking about, not what's going to happen in the future.
Amit, any final thoughts?
No, I think it was. Look, it was a good discussion. I think, you know, sometimes people think that like we hate each other or something like that. These are intellectual debates. The real winner is the audience, right? That got to actually experience everything and like see
Hopefully.
both perspectives. Yeah, hopefully. And dude, it's just very simple. I have a different approach of analyzing a company like SoFi. I use some of the qualitative stuff a little bit more than quantitative. Chris is super deep in the numbers. He believes the story will eventually play out. I believe the numbers are important. I just think there's other metrics to look at. Steve's upset about different things. Tannor has his own, like we all have different perspectives here. Ultimately, if the stock goes up in 2 years, Chris is going to be right. And he was like, and it was just, we're a little early, which is great. And I really hope that happens because I want him to make a crap ton of money. But the here and now, which is the point of this debate, is what is the market not seeing in this? And Steve and I think there's a certain segment of the business that is not being respected for potentially a good reason. You guys think that's not the case? Over the coming months, the market's going to decide.
Yeah, guys, this was a lot of fun. Really do appreciate on short notice because this all came together in a single day. Especially Chris. I don't know if people know, Chris actually has 15 children. So for him to even be here is incredible.
5 kids.
And
Plus
they
an
all-
exchange
and they-
student for the
And
last year.
they all have SoFi accounts. That's how he's pumping up these freaking numbers.
No, that's another thing, actually. They don't have custodial accounts, and I'm mad about it. And they better get it as soon as they transition. Oh, that was the thing. Can I say one more thing?
Yeah,
Sorry, that
go
actually
ahead.
is pertinent to the debate.
It's
That was
gonna
the thing I
change the whole
forgot
debate.
that I was going to say. I know we were finalizing this. I actually think one of the reasons, so I agree also that Robinhood's product velocity recently has been way better than SoFi's. And I think that there's also a little bit of recency bias in that, because back in 2022, SoFi was like 2021, 2022, SoFi was pumping out new things like all the time. It's one of the reasons that I invested is because I saw that product velocity. Robinhood has taken the torch and is doing a better job of that right now. I think, and I might be wrong about this, but I'm pretty certain that they are getting their entire tech stack onto Technisys, onto their own core by the end of this year. I think as soon as that happens, you will see product velocity increase a lot more because there's things that Technisys has built that are going to be really, really cool, but aren't there yet. Things like post-purchase, buy now, pay later. So you can like highlight these 5 purchases. I want to put them on BNPL. You just highlight them in your app and they go to like a BNPL. That's something that like is pretty unique and doesn't exist in other places. There's another thing that they just rolled out recently was being able to switch all of your like recurring charges from one financial application or one financial institution to another. So if you have Verizon, and one of the reasons people don't change banks is because it's a pain in the butt to change all of your like billing from something previous. They can do it. It's really, really slick. And they actually did do a product demo. Like there's a GIF of how it works on the actual Galileo website. It's really slick. You basically just log on to Netflix, say, I want to pay it from this account, and it does everything else in the background. So Galileo is rolling this stuff out in the background and nobody sees it because they announce it on the Galileo website. Nobody checks the Galileo website. They have a podcast about it. Nobody listens to the Galileo podcast, right? Like I know because there's like 200 views on each of those Galileo podcasts, like YouTube videos. Anyway, the point is, I actually think that the product velocity, and I will be really disappointed if it doesn't happen. Anyway, sorry, that was a point I wanted to make earlier on in the project.
And Chris, you're 100% correct. And you're right, it's the end of this year. And in addition to product velocity, there are also, Tannor, correct me if I'm wrong, it's 70 to 80 million in savings first year and then 60 to 7 annually after that.
And all that drops straight to net income.
Straight down to the bottom line, which is incredible. Once again, they have the ability to do so much, yet only hardcore SoFi people that follow this know about it and understand it. And it's a communication issue because these are the things that Noto should be jamming down the throats of everybody. And even if he didn't want to go on anybody's podcast, he could do his own and then have everybody redistribute it on theirs and get extra views, have everybody understand what's going on. But the analyst community does not really understand this stuff. And it is just a shame because there is so much underlying technology that they have, but they are unable to get the point across. The market pigeonholes them. And unfortunately, the way that they laid out the revenue and contribution profit pigeonholes them even further. And they need to have more discussions about the RFP process, where they are. Obviously, they signed NDAs. Obviously, they can't talk freely about things, but they can say, listen, We're competing in 12 RFPs right now. We are in the final stages of 3, and they are large scale bags.
They did say this in the
No.
last thing. They said 10 deals, and 8 of them are very, very close.
But they did not give a lot of information about it. They can give.
They said they'll be revenue generating by Q1 2026.
Q1 2026, but they're not giving enough information to get the analyst community to ask questions about it and create a buzz and get people to understand that this is not just a traditional finance company. They actually own the entire back end, and there is a platform that they are going to be able to cross sell, and they are in the process of potentially getting deals to cross sell it. And if they do, that tech revenue is going to jump tremendously. And you may see an S curve in it the way that you saw member growth. But unless they do a good job of communicating that, you're not going to get the multiple that we think it can get or it deserves.
Okay, let me wrap this though, because this has gone.
One thing can I say? All of us agree SoFi is not overvalued, right?
Yeah.
So I think that's one point of agreement. All of us agree SoFi is probably undervalued right here. Definitely not overvalued. It's just a question of the market perception of the company.
Yeah. But I think that's a margin of safety for SoFi as well. But ladies and gentlemen, thank you all so much for watching. Make sure you guys check out all our X's, which are on screen. Some of us are not. Most of you guys are even on Amit's channel right now. So I think Amit's on YouTube right now. Chris is on YouTube right now. Steve is on Seeking Alpha. Make sure you check out Stephen Fiorillo on Seeking Alpha. I think that's just what his ad is there. But thank you all. This has been a lot of fun. Hopefully you guys enjoyed it. Bye for now.